Right now, at this exact moment, two prices exist for the same ounce of silver. The official exchanges tell the world $71, but walk into a bullion dealer in Tokyo, Dubai. Try to buy actual physical bars, $130, 80% difference. Same metal. This has never happened before in modern markets. Not with gold, not with platinum, not with any functioning commodity. An 80% disconnect means one thing. One of these prices is a lie. And in January 2026, that lie is collapsing the entire silver market. Welcome to silver collapse. Coming. If you're a serious investor, a business professional who understands that markets don't break by accident, someone who wants the strategic intelligence that mainstream media won't provide, then you're in the right place. This channel isn't for entertainment, it's economic intelligence for people who make real decisions. Before we dive into this analysis, take a moment to subscribe. Not because we're asking for a favor, but because what's unfolding in the silver market right now is just the beginning, and you'll want this information before everyone else figures it out. Also, we'd like to know, where in the world are you watching this from? Are you in the United States, Europe, Asia? Drop your location. In the comments, we're tracking how this information is spreading and where people are paying attention. Now let's examine exactly what happened and why this 80% price disconnect represents something far more serious than a market anomaly. In the first weeks of January 2026, something unprecedented occurred in global financial markets. Something that had never been documented in the modern era of commodity trading. The silver market fractured into two completely separate realities. On one side sat the official price, the number displayed on financial terminals across every major bank and trading desk in the Western world. COMEX in New York showed silver trading at $71 per ounce. The London Bullion Market Association confirmed similar pricing. Every financial news channel reported these figures as the definitive price of silver, but on the other side, in the physical world, where actual metal changes hands, a completely different price existed. Bullion dealers in Tokyo were selling silver at $130 per ounce. Dubai market participants reported the same. Singapore physical traders confirmed identical premiums. When industrial users attempted to purchase actual silver bars for manufacturing, they encountered prices that bore no resemblance to what the screens displayed. The mathematics told a stark story. $130 versus $71, an 80% premium for the exact same metal, the exact same purity, the exact same 1 ounce bars. Financial historians searched through decades of commodity market data. They examined gold during its most volatile periods. They reviewed platinum price dislocations. They analyzed copper supply squeezes. They studied oil market disruptions. Nothing compared. Never in modern commodity markets had such a massive disconnect appeared between paper prices and physical reality. Small premiums occurred occasionally, 5% here, 10% during supply disruptions, but 80%. That wasn't a premium, that was a completely different market. The question facing analysts was simple yet profound. How could two prices exist simultaneously for an identical commodity in supposedly efficient global markets? The answer lay in understanding how silver pricing had functioned for the previous 4 decades. Since the early 1980s, silver price discovery occurred primarily through paper contracts. Futures contracts traded on the COMEX exchange in New York. Forward contracts in London, options, and derivatives layered on top of these instruments. These contracts represented promises to deliver silver at specified future dates. But here was the critical detail that most market participants overlooked. The vast majority of these contracts never resulted in physical delivery. Traders bought contracts, they sold contracts, they took profits or losses in cash, they rolled positions forward to the next month. The actual silver rarely moved from the vaults. The system worked because of one fundamental assumption, an assumption so deeply embedded that it became invisible. The assumption that physical delivery demands would remain minimal and manageable. COMEX operated on fractional reserve principles. The exchange didn't need to hold physical silver equal to all outstanding paper contracts, because historically, less than 3% of contracts went to physical delivery. Think of it like a bank. Banks don't keep every depositor's money in the vault. They lend most of it out. They operate on the assumption that not everyone will withdraw simultaneously. As long as that assumption holds, the system functions smoothly. The silver market worked the same way. As long as traders settled in cash, as long as delivery demands remained small, as long as everyone trusted the system, the paper market could determine the price. At its peak, the ratio of paper silver to physical silver reached 356 to 1/356 ounces of silver, promised on paper for every 1 ounce that actually existed in deliverable form. Then came January 1st, 2026. China implemented new export restrictions on refined silver, not a minor policy adjustment, not a temporary measure. A complete restructuring of who could export silver and under what conditions. Only 44 companies received authorization. Each required special government licenses. Each needed to meet strict production capacity requirements, annual capacity of at least 80 tons, net assets exceeding 100 million yuan. These restrictions effectively cut off 60 to 70% of the world's refined silver supply from Western markets. China wasn't just the largest silver refiner globally. China was the dominant source of the specific high-purity refined silver that industrial users required 121 million ounces annually. Now ring-fenced for domestic use, the impact was immediate. Industrial users who needed silver for manufacturing suddenly faced a terrifying reality. Their supply chains depended on Chinese refined silver. Those supply chains had just been severed. They couldn't wait for market adjustments. They couldn't hope for diplomatic solutions. They needed silver immediately for semiconductor production, for solar panel manufacturing, for electric vehicle components, for electronics assembly. So they did what any rational actor would do when facing critical supply shortages. They went directly to physical markets. They called every bullion dealer they could find. They offered whatever price was necessary. And simultaneously, traders who held COMEX futures contracts made a different calculation. If physical silver was trading at massive premiums in Asia, if supply was genuinely constrained, if China had cut off exports, then maybe it was time to actually demand delivery to convert paper promises into physical metal. In the second week of January, COMEX received delivery demands for 33.45 million ounces. In 7 days, 26% of the exchange's registered inventory gone, the assumptions that had supported the paper-silver market for 4 decades, the assumption that delivery demands would remain minimal, the assumption that traders wanted cash, not metal, the assumption that paper and physical prices would track closely. All 3 assumptions failed simultaneously. And when those assumptions failed, the 80% price disconnect appeared, not as a temporary anomaly, but as the new reality of a broken market. What most market observers missed in January 2026 was that the collapse didn't begin in January. The foundation had been cracking for years, silently, systematically hidden beneath layers of financial reporting and inventory data that few bothered to examine closely. The story of silver's structural breakdown actually began in 2021. That year marked the first time in modern history that global silver demand exceeded total supply. Not by a small margin. The deficit reached 95 million ounces. Analysts at the time dismissed it as temporary, a post-pandemic supply chain disruption. A brief imbalance that would self-correct 2022 arrived. The deficit widened, 112 million ounces. Still, market commentators remained unconcerned. Mine production would increase, they said. Recycling would fill the gap. Prices would signal new supply. 2023, 141 million ounces. The deficit was no longer temporary. It was structural. 2024, 187 million ounces. At this point, a few specialized analysts began raising concerns. But their warnings were drowned out by a market that seemed to function normally. COMEX silver futures traded smoothly. Prices remained relatively stable. The paper market showed no signs of stress. Then came 2025. The deficit exploded to 295 million ounces, the largest supply shortfall ever recorded. When adjusted for investment flows into ETFs and exchange-traded products, the true deficit became even more severe. Over the 5-year period from 2021 through 2025, the cumulative deficit exceeded 1.3 billion ounces, 1.3 billion ounces more silver consumed than produced. 1.3 billion ounces that had to come from somewhere. That somewhere was inventories. The above-ground stockpiles held in exchange warehouses, the reserves that were supposed to buffer temporary imbalances, and those inventories were vanishing. COMEX registered stocks told the clearest story. In January 2020, the exchange held 346 million ounces in registered inventory. Registered meant immediately available for delivery. Physical bars allocated specifically for settling futures contracts. By December 2025, 5 years later, that number had fallen to 82 million ounces, 346 million down to 82 million, a 70% decline. In 5 years, London told the same story. The London Bullion Market Association vaults held approximately 1 billion ounces in 2020. By late 2025, those holdings had dropped by 40%. 600 million ounces remained, 400 million had disappeared into consumption. Shanghai warehouses, tracked by the Shanghai Gold Exchange. The Shanghai Futures Exchange both showed inventories at their lowest levels in over a decade. This wasn't a regional phenomenon. This was global inventory depletion, systematic drawdown across every major silver storage facility in the world. But where was all this silver going? The answer lay in a transformation that had occurred quietly in the global economy. Silver's role had fundamentally changed. For centuries, silver served primarily as money, then as an investment vehicle, a store of value, something that sat in vaults. But starting in the early 2000s and accelerating dramatically through the 2020s, silver became something else entirely, an irreplaceable industrial input. Solar panel manufacturing alone consumed over 100 million ounces annually. Each solar panel required approximately 20 grams of silver. High-purity silver, irreplaceable by any other conductor at current efficiency levels. The global push toward renewable energy, the solar installations covering deserts and rooftops across continents, each panel pulling silver out of available supply permanently. Electric vehicles represented another massive demand source. Every electric vehicle contained between half an ounce to 1 full ounce of silver in electrical contacts, in circuit boards. In the sophisticated electronics that made electric vehicles function, global EV production was exploding. 10 million units in 2023, 15 million in 2024, 20 million in 2025. Each one consuming silver that would never return to the market. Then came artificial intelligence infrastructure, data centers powering AI systems, 5G networks expanding across the globe. The Internet of Things connecting billions of devices, each requiring silver components, each pulling from the same finite supply. Electronics manufacturing consumed another 300 million ounces annually. Medical applications, specialized industrial uses, photography, though declining, still represented demand. When analysts totaled industrial consumption, the number exceeded 700 million ounces per year. 700 million ounces going into applications where silver was consumed, used, destroyed, never to be recovered. Meanwhile, global mine production had plateaued around 820 million ounces, barely growing. In some years, actually declining. But here was the critical insight that explained why supply couldn't simply increase to meet demand. 75 to 80% of silver production came as a byproduct, not from primary silver mines, but from copper mines, zinc mines, lead mines. When mining companies decided whether to open a new mine or expand production, they calculated economics based on copper prices, on zinc prices, on lead prices. Silver was almost an afterthought. A byproduct credit that improved project economics but rarely determined whether a mine operated. This meant that even as silver prices rose, even as demand exceeded supply year after year, supply remained largely inelastic. A copper mine didn't increase production because silver prices doubled. It increased production if copper prices justified it. And primary silver mines, the mines that extracted silver as their main product, they represented only 20 to 25% of global supply. Building new mines required 8 to 12 years from discovery to production, exploring for deposits, proving resources, conducting feasibility studies, obtaining permits, securing financing, constructing facilities. The supply deficit that emerged in 2021, it couldn't be fixed quickly, not in months, not even in years. So as industrial demand consumed over 700 million ounces annually, as mine production delivered 820 million ounces, as investment demand absorbed another 100 million or more. The mathematics left only one possible outcome. Inventories had to drain, and they did, year after year. 346 million ounces at COMEX, becoming 82 million London's billion ounces, falling to 600 million. Shanghai's reserves hitting decade lows. By late 2025, the silver market was running on fumes, a structural deficit that couldn't be resolved, an inventory base that couldn't sustain continued drawdowns, a supply system that couldn't respond to price signals. The stage was set, not for a temporary disruption, but for a complete system failure. All it needed was a catalyst, one more shock, one more demand surge, one more constraint on supply. China's January 1st export restrictions. They weren't the cause of the silver market collapse. They were simply the match. Thrown onto a pile of kindling that had been building for 5 years. Available supply to move between markets, and that supply no longer existed in sufficient quantity. The silver available for delivery at COMEX, the 82 million ounces in registered inventory that represented barely 60 days of potential delivery demand at the January withdrawal rate. Sophisticated institutional investors recognized the math. They understood what happened when delivery demands exceeded available inventory. They'd seen this movie before. March 2020. Gold futures market. delivery demands exceeded available supply in New York vaults. The basis between futures and physical exploded premiums reached $40 to $50 per ounce. The Federal Reserve ultimately had to intervene, but that was gold, the monetary metal, the one commodity central banks cared about desperately, the one they'd support to prevent complete market breakdown. Silver was different. Silver was industrial, strategic, yes. Recently classified as a critical mineral by the U.S. government, but not money. Not in the way gold was money. Would the Federal Reserve intervene to save the silver market? Would they care if a COMEX failed to deliver? Would they support a market that primarily served industrial users and speculators? The uncertainty around those questions accelerated the breakdown. In the third week of January, something unprecedented occurred. The largest silver ETF, iShares Silver Trust, recorded a withdrawal 3 million ounces pulled from JP Morgan's New York vault. The first significant withdrawal of the entire decade. ETF withdrawals were rare. Investors typically bought or sold shares. The silver itself remained in the vault for 3 million ounces to actually leave. Someone had to specifically demand physical delivery from the ETF structure itself. Who was pulling that silver? Why now? And what did they know that prompted them to convert paper claims into physical possession? The ETF withdrawal triggered something else. A realization among institutional allocators, these massive funds, pension managers, sovereign wealth vehicles, insurance company portfolios, they held silver exposure through paper proxies, ETF shares, futures contracts, mining company stocks, streaming companies, derivatives. But none of it was actual silver. None of it guaranteed physical delivery. All of it depended on the continued functioning of a market structure that was visibly failing. The sophisticated money began moving quietly. At first, converting paper positions to allocated physical, demanding specific bars with serial numbers, arranging private storage, bypassing the exchange system entirely. This created a vicious cycle. The more institutions demanded physical delivery, the more pressure on already depleted inventories. The higher physical premiums rose, the more other institutions recognized the risk, the more they also demanded physical conversion. Meanwhile, industrial users faced their own crisis. A semiconductor manufacturer in Taiwan needed silver for production lines running 24 hours. They couldn't wait weeks for delivery. They couldn't tolerate supply interruptions. They needed guaranteed supply immediately. A solar panel manufacturer in Germany faced the same calculation. Production schedules were set, customer orders were committed. Any delay meant penalties, canceled contracts, lost revenue. These industrial users began bypassing exchanges entirely, private negotiations with miners, direct deals with refiners, long-term supply contracts at fixed prices, well above spot. Anything to guarantee physical supply. The exchange system that had provided price discovery for 4 decades, it was becoming irrelevant to the actual physical market. 2 separate markets were emerging: paper silver, traded on screens, settled in cash, decreasingly connected to physical reality, price discovery breaking down. Physical silver, negotiated privately, delivered in specific locations, priced at whatever level, guaranteed supply, no longer referencing exchange prices. The 80% premium wasn't a temporary dislocation. It was the market telling the truth. Paper promises and physical reality had finally diverged beyond reconciliation. And reconciliation would require something nobody wanted to acknowledge. Either paper prices would have to surge to meet physical, destroying leveraged short positions, bankrupting institutions on the wrong side, or exchanges would have to admit they couldn't deliver force cash settlement, halt trading, declare force majeure. Either path ended the same way. The trust that enabled paper markets to set prices, that trust was broken. And once broken, it couldn't be rebuilt with statements, or rule changes, or emergency measures. Markets run on belief, and the belief that paper, silver, equaled physical silver, that belief was gone. By late January 2026, market participants faced a reality that no longer fit within conventional analytical frameworks. The silver market wasn't experiencing a correction. It wasn't undergoing a temporary dislocation. It was fragmenting into multiple parallel systems that increasingly bore no relationship to each other. Financial institutions, industrial corporations, and government agencies began conducting scenario planning, not for how to profit from the situation, but for how to survive what came next. 3 distinct pathways emerged from these analyses, each with different probabilities, each with dramatically different implications. The first scenario assumed institutional adaptation. In this pathway, COMEX and other exchanges acknowledged the fundamental problem. They implemented emergency protocols designed to restore market credibility. Margin requirements increased dramatically. Position limits reduced to force speculators out. Trading restricted to commercial hedgers with legitimate delivery needs. Simultaneously, diplomatic pressure mounted on China. Trade negotiations repositioned silver export restrictions as a priority issue. Some compromise emerged, allowing limited exports under strict allocation systems. Western governments accelerated domestic mining development, emergency permitting for new silver projects, subsidies for primary silver mines, strategic stockpile releases to bridge the supply gap. Over 18 to 24 months, physical premiums compressed supply chains, adapted industrial users secured long-term contracts at higher but stable prices. A new equilibrium established itself with silver trading in the $85 to $100 range. Markets remained functional, price discovery continued, trust gradually rebuilt. This was the optimistic scenario, the managed stabilization pathway, the outcome that preserved existing institutional structures. But analysis of the January data suggested this scenario faced significant obstacles. China showed no indication of reversing export restrictions. Domestic Chinese demand was absorbing available supply. Their solar manufacturing sector alone required most of what they refined. Why would they export silver to Western competitors? Western mine development faced an insurmountable timeline problem, 8 to 12 years from discovery to production. Even with emergency permitting, new supply couldn't arrive before 2033. At the earliest, the inventory drawdowns were accelerating, not stabilizing. At current withdrawal rates, COMEX registered stocks would reach zero within 3 months. The optimistic scenario required multiple low-probability events to occur simultaneously. It required cooperation that didn't exist, time that wasn't available, supply responses that couldn't materialize quickly enough, which led analysts to the second scenario, the exchange system failure pathway. In this progression, delivery demands continued overwhelming available inventory. COMEX faced a choice between two equally unacceptable options. Option 1 was allowing registered inventory to reach zero, admitting they couldn't fulfill delivery obligations, triggering a cascade of contract defaults. Option 2 was implementing forced cash settlement before reaching that point, declaring that physical delivery was no longer possible, settling outstanding contracts in dollars at whatever price the exchange deemed appropriate. Either choice destroyed the exchange's credibility as a price discovery mechanism. Contract holders who demanded physical delivery would sue, claiming breach of contract, seeking damages, challenging the legitimacy of forced cash settlement. International investors would lose confidence in U.S. commodity markets broadly. If COMEX couldn't deliver silver, why trust gold futures? Why trust copper contracts? Why trust oil derivatives? The contagion risk extended beyond precious metals. Meanwhile, physical silver markets would completely decouple. Shanghai would become the primary price discovery venue for actual metal. Trading at whatever level cleared the physical market. $150. $200. Whatever price-balanced supply and demand for deliverable silver. Western industrial users would face sustained supply constraints. Semiconductor production disruptions, solar manufacturing delays, electric vehicle component, shortages, electronics assembly interruptions. These weren't theoretical impacts. These were production line shutdowns, lost revenue, missed delivery commitments, breach of contract penalties. Governments would face pressure to intervene, but intervention options were limited. Strategic stockpile releases provided only temporary relief. Price controls would drive silver into black markets. Export bans would trigger retaliation. This scenario represented systemic failure, not just of the silver market, but of the broader commodity, futures, infrastructure, the trust framework that enabled paper contracts to function as price discovery mechanisms. And once that trust broke in silver, why would it hold in other markets? The third scenario extended this breakdown into geopolitical fragmentation. In this pathway, export restrictions became the norm rather than the exception. Russia implemented controls on palladium and platinum. South Africa followed Chile-restricted copper exports. Peru followed strategic commodities were increasingly treated as strategic assets, not tradable goods, but resources to be controlled. Allocated, weaponized nations began building strategic reserves, not just of oil, but of critical industrial metals, silver stockpiles, copper reserves, rare earth holdings. A new resource nationalism emerged, where supply access depended on political relationships, trade agreements, strategic partnerships. The global price for silver ceased to exist. Regional pricing structures emerged instead, different prices in different jurisdictions, based on local supply, political access, strategic importance. Industrial users faced permanent supply uncertainty. Procurement became a geopolitical exercise. not a market transaction. Western economies confronted a strategic vulnerability, decades of outsourcing, refining capacity, decades of neglecting domestic mining, decades of assuming global supply chains would remain open. That assumption was breaking. In late January 2026, elements of all three scenarios were visible simultaneously. COMEX had raised margin requirements. China maintained export restrictions. Physical premiums remained at historic levels. Industrial users were negotiating private supply contracts. Some institutional investors were converting to physical holdings. Geographic price spreads continued widening. Which pathway would prevail remained unclear. What was clear was that the old system had broken. The system where paper contracts set prices, where futures markets provided price discovery, where industrial users could reliably source supply through exchanges. That system depended on assumptions that were no longer valid. The assumption that delivery demands would remain minimal failed. The assumption that supply chains would remain open, failing. The assumption that paper and physical prices would track closely destroyed market participants who understood these dynamics faced difficult decisions. For institutional investors, the question wasn't whether silver would rise. It was whether their paper exposure would actually capture that appreciation, or whether exchanges would force cash settlement at prices divorced from physical reality. For industrial users, the question wasn't about price, it was about guaranteed supply at any price. For policymakers, the question extended beyond silver. If a critical industrial commodities market structure could fragment this completely, what did that imply about broader commodity market stability, about global supply chain resilience, about the assumptions underlying modern industrial civilization? The silver market of January 2026 wasn't just experiencing a price spike, it was demonstrating what happened when financial engineering collided with physical scarcity, when decades of paper market expansion encountered actual supply constraints, when trust-based systems faced delivery demands they couldn't fulfill. The outcome wasn't yet determined, but the direction was clear. The old system was ending. What would replace it remained unknown. But for decision makers in business, finance, and government, the time for assuming markets would self-correct had passed. The silver market was sending a signal, a warning about what happens when the gap between paper and reality becomes too wide, about what happens when strategic commodities face genuine scarcity, about what happens when the assumptions underlying market structures fail. Those paying attention understood this wasn't just about silver, this was about the fragility of the systems that global commerce depended on. And fragile systems, when they break, don't break slowly, they break all at once.